Greetings. Happy Friday. Today we're looking at the Super Retail Group, SUL. Here's SUL's long-term chart. As you can see, this is another stock that has, 20 years of relatively consistent growth. You can see the trend line I've drawn. Hopefully you'll see that as fair. And you'll see that at the moment SUL is trading above that trend line, but the reason for the analysis of SUL today is this little line here, the 15% drop that Supercheap experienced yesterday. This is becoming something of a theme, the earnings season or the reporting season's cliff drop events. Something of a speciality, and the reason for that is that obviously I think these cliff drop events present a great opportunity to buy into a stock and start establishing a position, or to take advantage of a lower price to buy more of the stock, and by dollar cost averaging bring the average price of your shareholding down. As usual, I've taken the time to ask ChatGPT to compile a 10-minute script looking at the issues surrounding the Super Retail Group at the moment. And the reason I do this is, firstly, because it's a great way to get access to all the conventional reporting that ChatGPT has access to online, but also as a value add for viewers, because whatever you make of my analysis, you have the option to pause the video as we go through, read ChatGPT's commentary, and compare the two. It's a way of both acknowledging that anyone can have an opinion, but also to give you the opportunity to compare my analysis with what I call the cookie cutter analysis that you're likely to get from the average investment advisor. So, as suggested by ChatGPT, here's a look at the performance of one of the elements of the Super Retail Group's operations, Rebel. Now, sure, every stock has good and bad years. 2024 has been challenging for Super Retail Group, but, and I make this point very pointedly, the Reserve Bank has just cut interest rates, and what this sort of consumer discretionary stock is really looking for is discretionary spend on the part of retail consumers. Here are some of the challenges that ChatGPT has analysed on the basis of recent media coverage of the Super Retail Group. 3 factors: rising costs, increased theft, remarkably enough, although shoplifting is becoming something of a significant issue in the Western world, and the broader market context. The ASX has not had a good week. And here is some of that media analysis. Of course, for some of these sources, paywalls provide a challenge, but really, since some of these sources which don't have paywalls simply reproduce the opinions of the paid commentary, you can get access to this kind of reporting fairly easily on the basis of a Google search. But I take the opportunity in my commentary to remind viewers what we're looking for. BuyPoint ASX concentrates solely on ASX 300 stocks. What we're looking for is the opportunity to gradually build a position on stocks which all the indicators show are going to continue to grow. Certainly, investing, from my perspective, is about making money, taking profit. But if you adopt the approach that I'm suggesting, it's possible to develop a position, build a position on a stock where your dollar cost average is permanently below the current price action line. So you're always in profit. So if you come to the point where you want to sell out of a stock, you can do so at a profit. So PE ratio and market average. The PE ratio of the Super Retail Group is, as is described here, moderate. Generally, investors are looking for a price to earnings ratio of 15 or under. But there are specific conditions that apply to each individual company, and it pays to pay attention to these things, but you have to understand the significance of each of these indicators in the context of the individual stock. So here are the fundamentals. You can see that the Super Retail Group is a real company with a market capitalisation of over $3.5 billion. You can see that one of the things that stands out is a relatively high debt to equity ratio. Again, every company is different and the context in which they operate is different. So it's not necessarily the case that a high debt to equity ratio is a problem for a company at any particular time. What I would suggest is significant is the constantly and consistently growing revenue, the very consistent operating margin, which has only got better over time, and net profit after abnormals, which again has been gradually trending up, got a bit of a kick out of COVID, but has managed to hold on to the increase in profit that the company was able to generate after COVID. So what we're talking about today is particularly the cliff drop event that happened yesterday for the stock, a fall of 15%. There have been other cases, and this is the case with all companies, where there have been significant short-term price drops. In this case, ChatGPT has picked up one particular example in February 22, where there was a 10% drop, but within six months the stock had regained its previous levels and then some. So here is a focus on the recent chart for the Super Retail Group. You see the classic growth pattern of a higher low and a higher high, and you can see that that pattern was being repeated in the 2 months or the 3 months before this most recent cliff drop event. And the significance of the cliff drop event and the way you should respond to it, in my suggestion, should be based primarily on the recent history of the performance of the stock. So here ChatGPT is comparing concepts of short-term investment and long-term investment. My suggestion is that there's not really a difference between the two if what you're interested in is making a profit from your investments over a long period of time. Short-term events create opportunities, but if you're concentrating and confining your portfolio to stocks which have a history and the prospect of continued long-term growth, the short-term events pale in comparison to the dominant factor of the stock, that being that it has continued to grow over years or decades. So, taking ChatGPT's suggestion, I've overlaid the long-term price chart with the short-term price chart. What do those two things have in common? So here is the takeaway from ChatGTP. Again, this is the kind of mealy-mouthed 50-50 either or commentary that is pretty common in the wider investment analysis and commentary business. But I take the point that all this is only relevant to you making a decision. What do you think? Is the 15% drop that the stock experienced yesterday an overreaction? Or do you think that perhaps after 2 decades of relatively sustained growth, the super retail group is about to drop away from its all-time high? Here is the price chart once again, just focusing on the MACD and the ribbon of simple moving averages that I'm now suggesting you use as a second indicator on which to base your assessment of MACD buy points, such as the one here, which would have seen all of this growth before the price dropped to about the same level. What I thought, since there isn't a great deal to say about this particular cliff drop event, because it only happened yesterday, was just to give you a bit of an insight into the kind of commentary that I provide to my clients. This is a little snippet from the shared spreadsheet that I use to communicate with my long-term clients. I've been covering the stock since April. You can go back and compare the analysis with what's happened, and that's one way that I'm inviting viewers to assess the value of the opinions that I share in these videos. As usual, at least for the last few videos, I want to acknowledge the sources that I find useful. Simply Wall Street is an excellent source of conventional stock market analysis. I certainly use it, and if you're looking for a very wide-ranging and comprehensive source of conventional coverage and analysis of the stock market, Simply Wall Street really has to be up there. And here's the disclaimer.